Hello guys, first I want to start thanking you guys for the 1,000 subscribers. It has been amazing, the support from all of you, and if you're new to my channel, consider subscribing because definitely I am going to continue posting videos 3 times a week. In today's video, we are going to talk about 2 5G stocks that I think we have to have under our radar. For these, we have Ben from Stock Investment Analysis YouTube channel to help us analyze one of these companies.
Greetings everyone. Thank you Adriana, and thank you to everyone for watching this video. My name is Ben and I'm an investor who loves researching the stock market and sharing my knowledge with others.
Check out Ben's channel, it will be linked down below in the description. I really hope you enjoyed this collab and let's get started.
Today I want to talk to you about a stock that has more than doubled the S&P 500 over the past 20 years, has almost a 90% compound annual growth rate for their dividend, has shot up 130% in share price in the last year and a half, and will continue to beat the S&P 500 as it capitalizes on 5G technology demand. I am talking about Lam Research Corporation, ticker symbol LRCX. Lam is a company in the semiconductor industry. What is a semiconductor? You have likely seen these or pictures of these many times when looking at electronic devices. Semiconductors are essential components of most electronic circuits, and 5G innovation will require these for all the smart devices making up the Internet of Things, which is set to expand rapidly. Where does Lam come in? Lam works as a collaborative partner with the world's leading semiconductor companies, and as noted in their website, nearly every advanced chip is built with Lam technology today. This technology allows chip makers like Qualcomm, Broadcom, and Texas Instruments to build smaller, faster, and better performing electronic devices. I won't go into the details of the wafer fabrication process or the equipment they create for this, as it's just too technical, but just know that they are an integral part of the semiconductor industry, and these semiconductors are used in all of the 5G devices. If you're interested, check out their website as they have a long list of various solutions and products available. Their revenue is fairly well diversified by segment, although 56% relates to memory. Please note that many analysts are expecting a big boost in the memory segments over the next several years as 5G tech expands. Their revenue is also diversified by country, but the majority is going to countries in Asia. Lam returned almost $4.5 billion to shareholders just in 2019, almost $4 billion of which was through share buybacks. I mentioned a moment ago, Lam has doubled the S&P 500, so let's go look at their performance. We are looking at fast graphs, and if you look here, you will see that their average annual growth rate of their dividend has been 115%. The compound annual growth rate, which is what I look at, is at nearly 90% per year. That is extremely fast growth. Their total returns over the past 20 years average at 11.5% per year, whereas the S&P 500 only averaged 4.8%. In fact, an investment in Lam 20 years ago would now be worth about 4 times more than an investment in the S&P 500 over the same time period. This is very impressive. Here on Fast Graphs, we are looking at their earnings over time. The dark green are their earnings, which they have grown at 13.42% annually for 20 years. You can see the price to earnings ratio in black has followed earnings well up until a few years ago when it took a drop and has since overcorrected, going above the earnings line, which shows some overvaluation. Also note on the bottom that it has an A- credit rating, which is great, a market cap of $45 billion, which is a good size, and the debt to capital ratio of 52%, which is not unreasonably large, but I always prefer it to be smaller. If you had bought on that dip when the markets are rationally oversold, you would have made 130% in returns in the past year and a half. So what sorts of returns might we expect looking ahead? Here we are looking at the Fast Graphs forecasting calculator. You can see it is overvalued as the price is over the orange fair value line. However, if it continues to grow at the forecasted 17%, 22%, and 20% earnings over the next 3 years, and it returns to a fair value at a 15.85 PE, we will see a total annual return of about 11%. If it remains at its current valuation of a PE of about 20.6, we will see over 20% annual returns. I will gladly take both, but I see the first as the more likely scenario. Taking a look at current valuation for the share price compared to analyst expectations, we are looking at Finbox. The current price is in green. The analyst mean and median price targets are only slightly higher, and Finbox's fair value estimate is only a few dollars above the current price. This shows that Finbox and their analysts believe it is currently fairly valued. Given that expected growth, this indicates that this might be a good time to buy even after the massive run it has already had. Fidelity includes data from S&P Global Market Intelligence. They actually believe it is currently undervalued. On a scale of 1 to 100, in which 100 is very undervalued, they rate it as an 82, suggesting that this is a good price to buy. Fidelity also gives some data on the dividend. You can see here the current trailing payout ratio is only 33%. Given the speed at which they are growing earnings and how low the payout ratio is, I believe we can expect to see continued dividend growth, though not likely at such an amazingly rapid rate as before. Fidelity's valuation data shows its PE ratio, or the price to earnings ratio, is low relative to its peers and only at the 32nd percentile. The PEG ratio, or the price to earnings to growth ratio, is also at the 32nd percentile with a PEG of 1.64. Although I like to see the PEG closer to 1, and I like to see a PE closer to 15, compared to this industry, these numbers are still reasonable. Price to cash flow is average and at the 50th percentile. Price to sales is fairly average at the 64th percentile. Price to book is quite high and at the 89th percentile. However, price to book is often a less valuable metric for some of these tech companies, and I don't give it as much weight as the PE ratio or the PEG ratio when I'm evaluating a company that focuses on semiconductors. Looking at growth here, we see that their cash flow has grown at over 22% per year over the last 5 years, which is quite high for the industry and puts Lam at the 78th percentile. Earnings per share growth over the last 5 years was over 30% per year, again very high, and at the 86th percentile. The forward earnings growth is projected to be closer to 14% annually, which is more average for the industry and at the 39th percentile. Now we look at profit margins and returns. We want these to be as high as possible for maximum profits and efficiency. Lam delivers on both ends. Their margins are huge with profit margins of 23%, which places them at the 91st percentile compared to their industry. Other margins are similarly high as returns range from the 92nd to 96th percentiles. In other words, they are efficient and this is a great sign for investment. We now look at debt. Unfortunately, this is high, much higher than I'd like to see. Long-term debt to equity is over 100%. In other words, they have taken on more debt than they have in equity. This places them at the 86th percentile for the industry. Debt to assets and debt to capital are around the 80th to 85th percentile. This is higher than I prefer and higher than most of Lam's peers. The next question is whether Lam can handle this debt. The answer is yes. The current ratio is almost a 4, well above the minimum of 1 that we look for. This means it can handle payment of its debts in the short term. We also want to look at the interest coverage ratio. This is another indication of their ability to pay for their debt. We want to see a minimum score of 2, but a 3 or higher is preferred. We can see that their ratio is a 14.6, which is well within the margin of safety. Also bear in mind that although their total debt is high, net debt is not. Total debt is in purple and is over $5 billion. However, if you look at the red, that is the amount of cash and cash equivalents that the company has on hand. It has about $4 billion in cash and cash equivalents. In other words, even though they have over $5 billion in debt, if they wanted to pay off some of it, they could pay off $4 billion or almost 80% of that debt today. Now, I'm sure they have better uses for that money, but this makes me feel safer about this as an investment. In conclusion, I believe Lam is a great semiconductor company to invest in. It has produced excellent returns in the past and will continue to do so. I believe it'll benefit from the wave of 5G technology in the future.
My 5G stock right now is Skyworks Solutions. It is currently trading at a price of $130 per share, has a market cap of $21.8 billion. It has a PE ratio of 28.36, which is slightly higher than the industry and way higher than its 5-year average PE. For their Q2 2020, they reported a revenue of $766 billion, which is a decrease of only 5.4% in comparison with the same quarter last year. It also reported a decrease in net income. They reported $181 billion in net income, which is a decrease of 15.37% in comparison to same quarter last year. Something that I really liked about this company is their cleanest and awesome balance sheet. They have $1.1 billion in cash and cash equivalents. Also, total assets of $4.98 billion and total liabilities of only $833 million, not even a billion. The amazing thing about this company is that they have a huge liquidity with no debt, which in my opinion is impressive. Well, if you actually check Yahoo Finance, Macro Trends, Wall Street Journal, it says that they actually issued some debt for Q1 2020 and Q2 2020, which if you ask me, that seemed a little bit off for me because their SEC filing report said that they had no debt and would really like to know where these other sources are getting this data. But still, if they really have that debt in their balance sheet and we calculate the total debt to equity ratio, which is calculated by dividing their total debt by their total equity, it will be 3.6%, which is incredible for the industry. But well, I always trust their SEC filing, so for me, this company has no debt. Also, this company offers a dividend yield of 1.35%, which is 0.44 cents per share. Its previous 12-month trailing payout ratio was 25%, and currently they have a payout ratio of 38%, which is incredible since it leaves them a lot of room to keep increasing their dividend. Skyworks is a company that has almost every huge company as a client. They have Google, Amazon, Tesla, Samsung, Apple, Nintendo, and other huge companies you definitely want to have as a customer, and well, they have them. The huge thing is that the change from 3G to 4G was incredible, and now from 4G to 5G is world changing. 1G gave us a phone, then 2G the possibility to send text messages, 3G the possibility to transport us online, 4G the possibility to download things from the internet such as this YouTube video, then 5G will not only enable rapid communication and real-time video, but also will enable high-resolution video, autonomous driving. It will improve the data rate on your mobile 100 times. So we'll basically be able to download a movie in seconds. Also, 73% of cars are going to come with cellular connectivity by 2024. That is only 4 years away, and that is a huge thing for the company. Well, actually 3.5 years away because 2020 is already halfway done. Skyworks will also benefit from significant infrastructure opportunity with all the new 5G inventions, so they can expand content even more. Also, the smartphone market is reportedly growing at 4 times the growth rate of traditional cellular handset. Skyworks expects continued strength in their near future as all these products continues to gain momentum. It is a company that has outperformed the market in the last 10 years by a lot. It is up almost 700%, while the S&P 500 only 202%, which is a lot, but it's not 700%. And obviously, there are some risks involved while investing in this company. First, Skyworks' huge and strong competitors like Qualcomm and Intel. Then, 51% of Skyworks' revenue comes from Apple. So basically, Skyworks' growth is significantly dependent on iPhone's growth trajectory. In my opinion, the stock is really high right now and would not invest at these prices. I wish I would have seen this stock back in March when it was at $70, but well, I can't keep track of all the stock market. Would have been a very good investment since the potential growth that this company is offering with the new 5G, it's impressive. I do see this company and this stock growing exponentially over the next years. I'll link the presentation and their SEC filings down below in the description, just in case you want to study it even more. Let us know in the comment section below what you think about these two 5G stocks, if you own any of them or any other 5G stock.
Thank you again to all who watched. It was so fun making this video, and I hope you enjoyed watching it and learned something new. Which 5G stocks are you investing in?
Hope you enjoyed this video. Consider subscribing to both of our channels. Again, thank you for that 1,000 subscribers. It means a lot to me. Thank you and see you next time.